Welcome to another explainer. We're taking complex financial reports and translating them into crystal clear insights. Today, we've got something really fascinating. We hear about artificial intelligence constantly, right? Algorithms, large language models, cloud computing. But for all its virtual magic, AI requires massive amounts of physical space and power to actually function. So today, we're breaking down the Q1 2026 earnings of Digital Realty. They're a company that provides the literal, physical real estate powering the cloud and the AI revolution.
It's a serious question. Where does the AI boom actually live? When you type a prompt into an AI tool or stream a massive data set, where's that computation physically happening? You know, it's easy to think of the cloud as just floating up in the sky, but the reality is much heavier, much hotter, and requires a colossal footprint on the ground.
Well, let's dive into this. The physical home of AI is a modern, heavily fortified, incredibly complex data center. And Digital Realty operates as a massive landlord of this digital revolution. They own, manage, and lease out these fortress-like buildings filled with servers, cooling systems, and massive power grids. And as you'd expect, as the demand for AI grows, the demand for these physical buildings is just skyrocketing.
Okay, here's our roadmap for today's explainer. First, the AI infrastructure boom. Second, DLR's record Q1 earnings. Third, unpacking the leasing backlog. Fourth, financial health and dividends. And finally, their upgraded outlook for 2026. Let's get right into it.
Section 1. The AI infrastructure boom, from macro to micro. To really grasp the sheer scale of the demand we're talking about, just look at this number, $3.6 billion. According to their investor presentation, that's the massive amount of money Digital Realty's sponsor is expected to spend in 2026 alone. And that capital isn't for software development. It's being deployed just to address the growing physical customer demand driven by AI. It literally takes billions of dollars of concrete, steel, and power infrastructure to keep this digital wave moving. And the broader market is definitely taking notice of this trend. According to tracking from Quiver Quantitative, Digital Realty's stock jumped 3.8% on April 24, 2026, right after they released these Q1 results. This was driven heavily by the company's strong AI leasing momentum. Looking objectively at the data, it's pretty clear Wall Street is paying very close attention to who owns the picks and shovels of the AI gold rush. Moving on to Section 2. DLR's record Q1 earnings, the catalyst. First, a really quick definition. Because Digital Realty is a real estate investment trust, or a REIT, looking at standard earnings per share doesn't give us the best picture, mainly because of how real estate depreciation works. Instead, analysts look at funds from operations, or FFO. Now, what's really interesting about this slide is the significant jump in their core FFO per share. In Q1 of 2025, they were at $1.77. But in Q1 of 2026, they leapt to $2.04 per share. That is a really substantial expansion in their core profitability metrics in just 12 months. And driving that profitability is some serious top-line growth. Market beat data shows Digital Realty reported a massive 16.2% year-over-year revenue increase. Now, when a company of this sheer size is growing its top line at over 16%, it strongly indicates that the demand for their physical data center space is accelerating at a formidable pace.
All right, Section 3. Unpacking the leasing backlog, the foundation.
At the end of the first quarter of 2026, Digital Realty reported a total backlog of $1.8 billion of annualized GAAP base rent at 100% share. So what does that mean? It means they have signed contracts sitting in the pipeline, ready to generate $1.8 billion in rent once those spaces are fully built out and handed over to the customers. That's a massive runway of future guaranteed cash flow already locked in before the servers even power on. Now, to understand the stability of that revenue, we need to look at a metric called WALE, which stands for Weighted Average Lease Expiry. Simply put, it's the average time remaining until their current leases expire. Digital Realty currently boasts a highly stable WALE of 4.6 years. So not only do they have a massive backlog of revenue, but their current tenants are locked in for an average of nearly half a decade. That provides incredible predictability for their cash flow. But you might be wondering, who exactly are these tenants? Are they reliable? Well, this brilliantly illustrates that point. A staggering 79% of Digital Realty's customers are rated as investment grade. This means they're leasing space to some of the largest, most financially secure companies on the planet. This high customer quality adds a massive layer of safety and stability to that $1.8 billion backlog. Section 4. Financial health and dividends. So, a crucial thing to look at is how they manage their debt versus the health of their properties. On the debt side, they have a 3.7-year weighted average debt maturity, and crucially, 85% of their debt is at a fixed rate. In an era where interest rates have been a major concern for us all, having 85% of your debt locked in at fixed rates is a massive defensive shield. Plus, their property health is sitting at a highly robust 97% occupancy rate. Their buildings are essentially entirely full. When you combine that property health with their revenue growth, it creates a scenario that analysts are watching very closely. In partially summarizing MarketBeat's bull case on the stock, they note a dividend yield of approximately 2.8%. They also point out a very high payout ratio of over 128%, which they interpret as a firm commitment to returning value to shareholders. Based on all of this, analysts tracked by MarketBeat currently maintain a consensus rating of moderate buy, with the stock trading around the $215 mark at the time of the report. And just as a quick reminder, we're simply explaining the analyst sentiment here to understand market perspective. This isn't financial advice.
And finally, Section 5, the upgraded outlook for 2026, the horizon.
Let's move to this table and see how things are building across the year. Because of their strong performance in the first quarter, management actually confidently raised their guidance for 2026. Back in February, they projected total revenue between $6.6 and $6.7 billion. By April, they bumped both the floor and the ceiling up by $50 million. But more importantly, they raised their core FFO per share outlook from a range of $7.90 to $8, all the way up to $8 to $8.10. That is a significant display of confidence from management regarding their pricing power and demand for the rest of the year.
Digital Realty frames their strategy for capturing this demand into 3 distinct pillars. First up is delivering core value. This relies on the fact that 100% of their properties in this portfolio are freehold. They own the land and the buildings outright, which grants them maximum control and long-term asset value. The second pillar is ensuring sustainable operations. When you're powering the AI revolution, your energy consumption is literally immense. Maintaining these massive data centers requires a highly sustainable approach to energy procurement and long-term capital management. This ensures they can keep growing without being bottlenecked by power availability. In an era where a single AI prompt uses exponentially more electricity than a standard Google search, sustainable power isn't just good PR, it's a critical operational necessity. And the final pillar is accelerating future growth, and they have a massive engine to fuel this. They highlight an unparalleled sponsor acquisition pipeline of over $15 billion. This gives them an enormous pre-built pathway to acquire new assets and scale up as the global demand for digital infrastructure continues its aggressive upward march.
So we've seen the impressive numbers, the $1.8 billion backlog, the raised guidance, the 16% revenue jump. It's absolutely clear that the invisible world of software relies entirely on the incredibly tangible world of real estate. But it leaves us with a really compelling thought to end on today. As artificial intelligence models become increasingly complex and scale exponentially in the coming years, just how much bigger will its physical footprint need to be? I hope this explainer helped you visualize the concrete reality behind the cloud. Thanks for learning with us today.